Why do most $10 million or more real estate raises fail even when the deal is good? Most developers who fail to raise $10 million or more don't fail because the deal is bad. They fail because the structure is wrong before the first meeting starts. According to CBRE, a total U.S. commercial real estate investment is projected at approximately $562 billion for 2026. The capital is there. The problem is that access to that capital is more structure sensitive than it has been in any prior cycle. What is a capital stack and how does it work for a $10 million plus real estate deal? A capital stack is the complete set of financing sources used to fund a real estate project, ranged from least risky to most risky. For deals in the $10 million to $75 million range, the stack typically includes senior debt at 50 to 65% of total cost, targeting 5 to 8% returns, mezzanine debt at 5 to 15%, targeting 10 to 14%, preferred equity at 5 to 15%, targeting 12% or higher IRR, LP equity at 15 to 30%, targeting 15 to 25% IRR, and GP equity at 2 to 10% of total costs on a promote-driven basis. Each layer has a different cost, a different claim on cash flow and collateral, and a different set of return expectations from the people providing it. What three market shifts changed how institutional capital evaluates real estate deals in 2026? Shift 1, banks pulled back and senior debt proceeds shrank. Regional banks tightened dramatically, with 72% reporting tightened lending standards, pushing senior loan proceeds down to 50 to 60% loan to cost on development deals rather than the 65 to 70% many developers still assume. Shift 2, private credit expanded past $2 trillion in assets under management, but prices risk aggressively. A developer who approaches a private credit lender with a messy stack will get an expensive term sheet, not a pass. Shift 3, institutional LPs shifted their evaluation criteria from projected IRR to downside protection, according to Cushman & Wakefield's 2026 outlook. Investors are now prioritizing cash flow growth and downside protection over cap rate compression. What is the 5-step institutional sequencing framework for building a capital stack before outreach? Step 1, start with the downside case. Model the project at 10 to 15% over budget, lease up taking 6 to 9 months longer, stabilized occupancy at 88 to 92%, and a 200 basis point rate shock. Step 2, size senior debt based on what survives lender stress, not what the pro forma needs. In most development deals today, that number is 50 to 60% LTC. Step 3, identify the gap and choose the right instrument. Increase sponsor equity, mezzanine or preferred equity, or reduced project scope. Step 4, model LP returns before setting the waterfall. If the LP return in the base case does not clear a 15% IRR threshold, the stack needs to be rebuilt. Step 5, set GP economics last. The promote structure should reflect what the market will bear, not what the sponsor wants on paper. What's the difference between mezzanine debt and preferred equity in a real estate capital stack? Mezzanine debt is a loan secured by a pledge of equity interest in the property owning entity and requires an intercreditor agreement with the senior lender. It's currently pricing at 10 to 14% for well-structured deals. Preferred equity is structured as an equity instrument rather than a debt instrument, carries a fixed minimum return of 12% or higher, and is paid before common equity receives any distributions. Banks often prefer preferred equity over mezzanine for regulatory reasons, which has made the more common gap-filling instrument in bank-led construction structures, but preferred equity is still expensive capital and should not be treated as substitute for sponsor equity. How should GP economics be structured for a $10 million plus institutional raise? A reasonable institutional structure for a $15 million to $50 million development deal here in 2026 looks like this. A preferred return to LPs of 7 to 8% annually on invested capital, a catch-up to the GP until the sponsor has received approximately 20% of total distributions, and a split above the hurdle of 70 to 80% to LPs and 20 to 30% to the GP, depending on deal size and risk. GP equity should be no less than 5% of total project cost. Thin sponsor equity is one of the fastest ways to lose institutional confidence. The promote should reward outperformance, not compensate for underperformance. What are the 6 structural mistakes that cause institutional capital to walk away from a real estate deal? Now, mistake number 1, using the capital stack to patch a weak model. If the project only works at maximum leverage, With every assumption at the top of the range, the stack is hiding a deal problem, not solving a financial problem. Mistake 2, backing into the senior debt assumptions by targeting 65% LTC and then finding a lender willing to hit it. Mistake number 3, treating preferred equity at 12 to 16% as cheap quasi-equity without modeling its impact on LP returns. Mistake 4, ignoring refinancing and exit risk, a stack that works at construction but cannot be refinanced at stabilization is not a complete structure. Mistake 5, starting outreach before the waterfall is presentation ready. Institutional LPs will ask for the full waterfall in the first or second meeting. Mistake 6, presenting only the base case. Institutional capital managers model downside scenarios and single scenario presentation signals the stress testing has not been done. How do you know if your capital stack is ready for institutional outreach? A capital stack is ready for institutional outreach when it passes 3 tests. First, it survives a stressed scenario of 10 to 15% cost overrun, extended lease-ups, and a 200 basis point rate shock without breaking the deal or wiping out LP returns. Second, every layer is sized based on realistic market terms, not optimistic assumptions. Third, the GP economics are transparent, proportionate to deal risk, and documented in a waterfall that can be presented clearly in the first or second meeting. If any of these 3 tests fail, the stack is not ready for outreach. Check out the channel for more videos.